Hello, my name is Taylor Dolinik and I did PeachTree Case A for Shahrokhi 139. For number 1, the T-bond is independent of the economy and will return 8% no matter the state of the economy. The T-bond is not absolutely risk-free. It still has risks associated with it, such as inflation and interest rate risks. For number 2, the rate of the return for the T-bond is 8%. For TICO is 13.5%. Gold Hill 8.8%, S&P 500 is 15%. The entire portfolio return would be 45%, and I would pick S&P 500 because it has the highest return of 15%. For number 3, the standard deviations of the securities, T-bond is 0, TICO is 0.117, Gold Hill 0.09, S&P 500 0.16. The standard deviation and coefficient of variation measure how the numbers are dispersed around the mean. The coefficient of variation is better because it standardizes the measure and relates the risk and expected rate of return. Number 4, if an investor chose TICO and Gold Hill and invested $10,000 into each company, the expected return of the portfolio would be 11.15%. Standard deviation would be 2.89%, and coefficient of variation would be 2.59%. It is far less risky to have these stocks as part of a portfolio. If the portfolio was split 75-25 with Gold Hill 75%, its return would be 9.9%, and if TICO had the majority of the return, 75%, the return would be 12.3%. With TICO and S&P 500, this portfolio would not have the same risk-reducing effects because they are positively correlated stocks, so this indicates more risk. Number 6, if more randomly selected stocks were selected, the portfolio risk would decrease because more investments equal a higher spread. As long as the stocks are negatively correlated, they will offset each other and make the return higher and reduce risk. Investors do need to be careful when picking stocks and looking at correlations with other stocks. A portfolio does impact the way an investor should look at the riskiness of individual stocks. This would change the company cost of capital depending on how much the stock increased or decreased. When it comes to risk, total risk identifies all risk factors associated with a specific action and its potential for financial gain or loss. Diversifiable risk is specific to a particular security, and market risk is associated with the market and the market factors. Choosing a single stock will not guarantee an investor any compensation because having one stock is very risky and it does not diversify a portfolio. For number 7, plotting a scatter diagram creates lines called value lines. They reflect the beta and can also be called regression. They're important because they show the independence of the variables. For number 8, a required rate of return using the capital asset pricing model has a return of 12.2%. Investors should invest in TICO because the beta is low and the return is plotted on the security market line, so it's even. For number 9, if TICO's return was impacted by inflation, the return would be 13.4%. If the required rate of return increased by 1%, the return would be 12.8%. If the beta was changed to 1, the return would go up to 15%. Efficient market hypothesis is a theory that says it is impossible to beat the market. The impact it has on decisions concerning investments is that investors need to realize they will not be able to beat the market, and it is not applicable to real assets such as plant and equipment. It does impact corporate financing, so investors need to be careful when they are choosing their stocks. When it comes to adding staff to Jake Taylor's firm, he should do it because it will help give him an advantage on his returns. For number 10, with long-term debt ratio decreasing, the impact on risk would be less because there's less debt to pay off. And low debt is an indicator that a company is doing really well and that they're no longer relying on debt to help the company. And that's what I got for my case. Thank you.